All right, Scott, over the past decades, it has been suggested to buy the market, more specifically the S&P 500 for diversification. Is the S&P 500 diversified in your opinion?
Oftentimes we're on similar pages. On this one, we're not. And I'm not going to talk about the railroads because we're not playing Monopoly here.
Why don't we play Monopoly?
Which version? We've got Star Wars Monopoly, Rasta Monopoly, Gallipolopoly, Edna Krabopoly.
We're talking about the S&P 500, and we have extreme concentration risk. We have 10 companies that represent 40% of the overall. We have a sector that is now close to half of the overall S&P 500. So we have sector imbalance. We have extreme concentration risk. We have a market cap weighted index that creates a momentum trade, which is not diversification. That is chasing momentum. So we don't have true asset diversification as well. When you talk about international and global companies, these companies are denominated in US dollars. So we don't have diversification on the US dollar. We don't have diversification with small cap stocks. What we're also having to look at is the theory of contagion. Because when volatility spikes, correlation goes to 1. Assets tend to move together down. So when I look at the S&P 500, I'm looking at those components and how they typically correlate to 1 when we're going through a high bout of volatility. So no, I'm on the other side, that the S&P 500 is not diversified. It is comprised of the 500 largest equities that are multinational companies, but I believe true asset allocation begins at the asset class level and not specifically at the individual companies.